Hello traders, it's Tuesday, February the 25th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you a wrap-up of the opening 24 hours of this trading week and an out for what we can expect in the coming 24 hours and beyond. In terms of price action, we did have some very remarkable developments in the capital markets, not necessarily the FX markets, to open up this new trading week, though it is nevertheless something to take note of because it can easily spill from one asset class into another, as we've seen many times in the past. So what was the big headliner move of the day? Well, it was without doubt this S&P 500 development. We were, through most of the U.S. session, above that 1850 level on the benchmark equity index. But as you can see, when it came into the closing, the market was unable to hold that major figure. This is both on derivatives, this is CFD, happened also on the futures, as well as the underlying spot market, the S&P 500 index itself. None of these were able to hold this break. However, the break itself and the reluctance to show follow-through are exactly what the conditions are that we've been talking about. As we are anchored to this very substantial resistance, we have a market that is unwilling to reverse itself. All right, so it's a lacking commitment, whether it be bullish or bearish, and the fading of liquidity. The lack of participation in this market is actually making it prone to breakouts. The problem is that these breakouts ought to turn into false breakouts, or they can break and hold, but they won't develop into momentum. Right? These are essentially widowmakers for traders who like to see breaks and assume that they immediately turn into new trends. That doesn't necessarily happen, especially when we have something like this and the fundamentals that back it. Record highs, meaningful resistance, and questionable forecasts for growth, interest rates, and returns. So can we, in the upcoming session, or maybe one of the subsequent sessions, actually see the S&P 500 make a break and actually hold? Absolutely. But we have to remain dubious of the follow-through that will actually accompany it. All right? And this is not just a U.S. equities consideration. This will spill over to Asia equity markets. This is what we're watching right now in this current session that I'm filming. This is the Nikkei 225. We're hovering right there around that 15,000 mark. Very important mark for this particular index. And as you can see, we have not committed one way or the other. The European markets will take it up next. The UK, or FTSE 100, actually managed to peak a new high, a multi-year high, in this past session. We want to see if these indexes are able to actually build traction. All right? And as we start to see, or if we do see another push for risk trends, these indexes will all show the same, but it might finally show a little bit more influence over the FX market. We know what the risk-sensitive currency pairs are in the market. We have watched them numerous times before. We've discussed them in previous trading videos as well as previous strategy videos. But we first, on the risk sensitivity curve, meet the emerging markets. Right? If we want to look at something that is exceptionally sensitive to the risk on, risk off, regardless of the direction, really just looking at the amplitude of this consideration, we want to look at the emerging markets. I prefer looking at the dollar ZAR, and I prefer looking at the dollar peso, Mexican peso, because those are more consistent. And while they will exploit a lot of volatility, they won't be the directionless, huge jumps volatility. It will be very consistent, or more consistent than what we're used to in other major, or at least other very high profile as of right now because of news stories, emerging market currencies like the Argentinian peso, which we really can't even trade because of the essentially government fix, or other more volatile emerging market currency pairs. But as you can see, as the risk trends rose, the ZAR, the South African rand itself, pushed into this support. All right, so favoring the ZAR, over the U.S. dollar. And this is a considerable sensitivity. Look at the pace that we've put on this 8-hour time frame. All right, quite a drop, quite a significant drop, in fact. However, if we want to see risk trends really pick up, and we want to see at least the next jump, the next iteration, the next upgrade in risk trends, we want to see it happen into yen crosses. All right, these yen crosses are very sensitive to risk trends, and when we do see a committed move, whether risk on or risk aversion, particularly towards risk aversion if it's heavy enough, you will see these pairs respond. However, when we look at some of these yen-based crosses, we'll start with the dollar yen. It wasn't really moving substantially at all. It actually held quite nicely to its own range. You can see here. All right, the dollar yen is certainly one of the more buffered to risk trends. But we did see that the similar circumstances for the pound yen, which is carving out this wedge. Remember where this wedge stands in the bigger picture. It's always important to put it into context. All right, still carving out that wedge. Euro yen, similar circumstance, wedge, but remember, bigger context. All right. But we did have, interestingly enough, it's been these two currency pairs, the euro yen and the pound yen, which have been most accomplished when we're trying to find progress on the yen crosses when it's based on risk trend. But in reality, we've seen actually much of the volatility come through on Aussie yen and Kiwi yen. Now, normally, we would expect these currency pairs to be very sensitive to risk trends, normally. But as of late, they have not been. The Aussie dollar and Kiwi dollar have been holding off from both risk-on and risk-off sentiment pretty consistently, which is a surprise given their carry trade status. But nevertheless, they have held off. Well, this was different this past session because, as you can see here quite clearly, they have both made significant moves. The Aussie yen is particularly interesting. If you want to look for, or if you're trying to highlight a currency pair that would be able to take advantage of a continued risk-on. And remember, there aren't many great currency pairs that have a risk bearing that are oversold. Right? Not very many of those at all. But if we wanted to look for some, Aussie yen, especially when we're talking about not just the considerations of risk trends, but also fundamentals. The Aussie dollar is seriously underappreciated for its interest rate forecast, which, though has not turned to a full expectation of a rate hike and the subsequent hikes that would follow the first move, we can see that the market is starting to turn from a dovish into a neutral standpoint. And once we hit that stance, the next iteration, the next development, is going to be one of rate hikes. Right? And if we start talking about rate hikes for the Aussie dollar, that would be a great leverage to a risk-positive scenario. And you can see the trend line that we have right there. The technical pattern is quite clear. If we get a break above this, you can call it range high at around 93, or you can say this trend line above 92.75. That would be a good, clear move. We can also see risk on is probably a good setup for something like the dollar ZAR, which has had a one-sided move for quite a long time as capital has fled the South African and all emerging market capital markets. Starting to see some of that market move back as the S&P 500 not necessarily makes a strong charge, but at least puts a cap on fear for the interim period. Those are currency pairs that can actually take advantage of that. But risk on, as we can see, is an asymmetrical opportunity. While we can see it's a high probability, so more likely to continue in that direction, the potential to the upside, when we're already at record highs, is going to be far more restrained than the potential to the downside. Imagine if we had a correction versus a bullish breakout. We don't have to imagine the bullish breakout. We actually did have a bullish move this past session. It's limited. It doesn't naturally generate a lot of interest and follow through. If we had a move to the downside, it's easier to imagine that there is a significant unwinding that could evolve from that move, whether it be a fundamental correction, markets being just simply overbought, or something as structural as an excessive amount of leverage that has to be unwound. It can be one of the two, but actually they would probably come close in hand. So risk aversion, if there were a development on that front, plenty of opportunity. I would absolutely love the yen crosses in that kind of move. Specifically, I prefer the euro yen and pound yen for their exposure, especially the pound because it's a little bit overwrought in its expectations and has moved too far too fast in its BOE expectations. And subsequently, when we see those interest rate forecasts fade or ease, that will put the pound in a sensitive position. Add something like as proactive risk aversion to that mixture, and it's easy. It's an easy break. All right, easy break to the downside. Get it far enough down, and you can actually break this long-term trend line as well. But that's a few too many steps ahead. In the upcoming session, We'll be watching for those risk themes. We'll be keeping a close eye on them. We can't afford to take our eyes off of it at this point. They're just too important to the broader schema of the markets, whether we're looking at all the volatility measures, all the risk measures as these actually stand out to be across all the asset classes, as we see here. They're deflated, absolutely. We want to isolate it to the two that I pay most attention to, equities and FX. You can see both are deflated, although equities are making a very, very consistent go of it over the past year and a half or so. Or we can look at something that is a little bit more isolated. We can look at the S&P 500 and its relationship to volatility. We know how important that is, the limitations to how much more volatility or vols we have to deflate, or risk aversion premium that can be unwound, limited. And we can also look at the US dollar and its relationship to FX volatility and the need that it has to make a break one way or the other, continue a move to the upside or make a break to the downside. The dollar index, if it wants to break this trend line, we need some level of volatility. All right? And it just so happens that the FX-based volatility index, this is the 3-month tenor, is in a nice range. It can either break the bottom of this range or it can move back up to the top of the range, and that would be a good impetus for a dollar rebound. All right? One way or the other. The dollar is going to start to try to price in its safe haven status for positive or negative. That is a theme that will start to return. In the meantime, monetary policy is going to be an ongoing circumstance. Risk trends are going to be an ongoing consideration. Those two themes will be trading on and off. We'll always keep risk themes in mind, and if anything risk sensitive develops or any news related to risk trends evolves, that is what we're going to have to pay attention to immediately. It will easily override almost anything else that the market has to throw at us. But as it happens, the event risk on the upcoming docket does not necessarily have big, heavy-weighted fundamental event risk or news or speeches or anything like that that we can reasonably foresee. And that is going to probably limit our expectations, our natural expectations of a risk-on or risk-off scenario. Now, I think it's probably a pretty good probability that you do have a little bit of a follow-through on risk-positive scenarios because of the S&P 500, but that's not going to come with a lot of momentum to it. In terms of the docket items that we should be watching, there are a few, as you can see highlighted in the Manic Crisis calendar. You can also see many of these on the Daily FX economic calendar. But I'm going to be paying attention to the Fed commentary. As you can see, we have Tarullo, who doesn't necessarily speak very often, so it's going to be interesting to see what he has to say. This will tap into taper and maybe even go as far as influencing the relationship of risk trends to taper speculation, but we haven't seen that to be the case very often as of late, so I'm not going to expect something that aggressive. We do have greater potential in maybe the South African GDP figures. Now, we were just talking about the dollar ZAR, and if you want to follow the dollar ZAR, this data is going to be very important, particularly to that currency pair. This can also have a broader emerging markets influence as well, considering how this event risk comes out. If the region, the high-flying region, the fast-growing region, starts to show immediate contraction based on early outflows of capital, that could be a sign of very, very disastrous proportions. So we have to watch this as an indicator as well. We don't often watch these kind of indicators for influence over the broader market, but this is not the market. Those markets of the past are not the markets we have to work with right now. Emerging markets have proven themselves to be quite influential on a broader scale, almost getting all the way up the risk sensitivity curve. We also have Venezuelan GDP. This has been a big story, Venezuela, and the problems that they've had there, especially as it relates to the exchange rate, though there is no specific time connected to this. It is now, the range has been pushed out to potentially any time this week. All right, so it's not very easy to establish when this is coming out. I wouldn't hold my breath on expecting this, and if the market can't expect it, it doesn't really establish a expectation, a build-up, and a strong reaction as we have seen in the past. So, limiting my expectations there. Two other pieces of event risk that I think are certainly worth highlighting: the consumer confidence report from the U.S. This is going to be important for the Fed officials as they assess the situation and their continued influence through taper, as well as the EU's economic winter forecasts. We want to see what their expectations for growth are. Remember, the ECB has been holding off on monetary policy, even though this monetary policy is potentially necessary, further easing, to help out growth and to prevent financial pinch, especially as the banks are facing a stress test that, given what we've heard from these officials, is likely to find a couple banks failing and shuttered. All right, this is going to be a tough 2014 to say the least. It definitely won't be easy, but will the ECB take the initiative? Will it preempt problems later down the line and go under the guise of deflation when in fact they'll probably be doing something to stabilize and reinforce the financial system? That remains to be seen. The Euro USD, nevertheless, does have very interesting technical basings. You can see that we have a 100 pip range here, and a breakout is exceptionally likely in the short term. However, if you're looking for a breakout from this particular range, be very careful about what your assumptions are depending on what side we go. If we go to the upside, breaking a 100 pip range, yes, clearing that 137.75 level would be a good signal. However, the follow through would be very, very significant, all right, as with any trade. What kind of follow through will we expect if we're breaking that 100 pip range and coming right into this long-term multi-year trend line, which creates a much larger wedge? Right? That's about 138.50. It doesn't give you much room to run. Alternatively, just a pure technical or modest fundamental break that it occurs to the downside has a range that it can fill in without much natural resistance. Right? Not much to curb its move. It can easily move back down to the bottom of this range and not be a questionable or high-intensity move or deemed such until it actually gets down to the bottom of this rising wedge resistance here, or support here. So this is going to be a very interesting currency pair. It has short-term, medium-term, and long-term implications. Of course, you have to play them in the order that they are, the time frames that they represent. I discussed this currency pair more in detail in today's strategy video, so you can check it out there. But the majors are actually giving us a lot of good looks. It's just not being very proactive like the S&P 500. The pound dollar, after that 5-day March lower, we had an up day, however, didn't really clear this descending channel, which is now turning into a pennant or flag formation. We have the dollar yen, which we discussed, is a nice wedge, rising wedge, much like this descending wedge that preceded it, but without the kind of amplitude or pitch or angle that the previous move had. And Aussie dollar, trying to work its way up into this resistance at 90.80, hasn't committed itself to a break, but given how tight this range is, even this relatively stoic pair is likely to find a break in the near term. These are the majors. You can also take a look at some of these other currency pairs that we've been discussing on and off for some time. Euro, pound, you can see the top of that, or within 20 pips of the top of that descending channel here. Aussie CAD, I actually decided to take the second half of my long position off. Remember, I got in here after it held this trend line because it hasn't made any progress. I booked it for 135 pips on the second half. If it breaks above this parity or parity plus 50 level, then I'll consider going back in. But for now, it is showing itself to be relatively limited in its natural follow through. Aussie Kiwi, developing that head and shoulders pattern. That right shoulder is in place. Will it break? We'll have to wait and see. Kiwi CAD, continued advanced wedge now into the 92.50 level. Remember, this is already at an exceptional level. A lot of opportunities. We can look at these opportunities from the majors. We can look at the opportunities from the more risk sensitive, even pound Aussie and Euro Aussie with these head and shoulders patterns. These are a little bit more risk sensitive. Yen crosses, of course, are risk sensitive. We can even look at the pairs that don't have that risk sensitivity and are offering us a different view overall, which is a little bit better for the consistency in technicals, something like an Aussie Kiwi. A lot of opportunity, whether we're concerned about fundamental disruption or whether we're just looking for certain types of short, medium, or long-term setups. We have to know what we're looking for, and we have to know how we're positioning for it when we do find it. All right? So keep your eyes open over the next 24 hours. It's going to be interesting for risk trends, as always. Not expecting too much, but do keep a close view on emerging markets and the taper versus QE argument across all the majors, which is an ongoing element for the market itself. We'll wrap you up once again tomorrow and give you forecasts for Wednesday in tomorrow's session. Until then, good luck trading out there and have a great evening.